It's a mixed picture as we speak. Most of the indices are trading with gains.
DGGI, Bangalore zone, claims Infosys for tax evasion.
Fed is closer to rate cuts if data cooperates.
There is the Supreme Court verdict overhang, and for now, they've put in a contingent liability of around 17,000 crores.
25,000 plus on the Nifty is what you have, and we are at a fresh all-time high, of course.
Currently, the market mood is slightly more driven by liquidity and sentiment.
We've seen growth very substantially, even in a flat market.
Nifty sitting at around 25,000 at this point in time.
Sources have told CNBC-TV18 that the company started its conversations with a single player here, and that is KEC International.
There are 3 potential suitors that have received this fit and proper certificate from the RBI for the acquisition of IDBI Bank.
The demand has been slightly muted this year right from the beginning.
We will be $68 billion of the size of the market by CY28.
Mid caps, they are lagging today.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Okay, well, 25,000 is done, and I think the market is just taking a break. This is, of course, Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surubi and Nigel. Guys, hi, good afternoon.
Hi, good afternoon. So we got 25,000, then some profit taking, that kind of a day. But I don't know, maybe taking profits not such a bad thing at these levels.
You know, the last few minutes, what's happened is the Nifty Bank actually has slipped, and SBI comes out with a set of numbers, I think, over the weekend. So that one actually has taken a sharp knock. Let's see how things go. The problem, I think, today is the broader markets, which have been outperforming, but today it's coming for a bout of profit again.
I mean, I think actually started yesterday. Yesterday in the last hour, the small cap index sold off, and today it discontinued. So you look at the small cap and mid cap indices, there is a full 0.75% cut on each of those sectors. Actually, it's more now. So that this 0.75% at about 220, and as we start, there's been a bit more of a slip. So full 1% plus cuts coming through on the mid and small cap part of the market. Market breadth has been negative from the word go. After the first 1 hour, to be fair, 2:1 declines to advances. So market breadth is negative. It is largely a few large caps which are holding the index higher. So 20 odd points on the Nifty is what you have, 30 points below that 25,000 level. No help from the Nifty Bank once again. That has been the weaker of the two indices, and I think that is also one reason why even on large caps there isn't very much by way of momentum which is visible. So can't complain too much because, I mean, the market here has been astoundingly strong, even though some of the global markets, even US, for example, over the last few days has had 1.5-2% cuts, but the market here did not budge. So you're just kind of sort of catching up a little bit to what has already happened around the world. So don't look at the last night's 3% rally on the Nasdaq, and so expect a sort of equal kind of a reaction here. There is what has happened over the last 2-3 weeks or so, which is a bearing on as to why the market is not responding in full force. I think some of the global markets also should come up a little later on the screen, and they'll explain the picture more. Surabhi.
Absolutely, Prashant. In fact, I was looking at that. Today we're in the middle of what US did, the exuberance over there, and what Europe is doing right now, because European markets are down over 1%, many of them. The major ones, the DAX, the CAC, all these markets are down between 1 to 1.5%. So in that context, and then of course you had the Japanese market sell off big time today. So in that context, maybe not too bad. We are managing to just about stay around the flat line. Now, the push and pull factors for the large cap screen. The thing is that, of course, it was Infosys which started with that negative news on the GST demand in the morning. But a couple of other tech stocks are also now more on the red side of the screen than the green side. So that's one area that's putting in some pressure. A lot of auto stocks losing momentum today. That's been the story right from morning. Not just Mahindra and Mahindra, but other names. Tata Motors, which is going to be reporting today, down 2.5%. There are the others like iSure, etc. So auto as a space is losing some ground. Tech as a space is a bit weak. There are the biggies like L&T on the downside of the screen. And then you come to the banks. Banks are really split. Had it not been for HDFC Bank, the bank Nifty picture itself would have been a lot weaker because SBI, Kotak Mahindra Bank, IndusInd, all of them are down. This one is making up for it. So that's why the bank Nifty isn't looking at a bigger decline. On the upside, batting for the bulls, apart from HDFC Bank, a couple more names. So some of the PSUs are having a great show today. Coal India, Power Grid, these are stocks, even NTPC for that matter, ONGC. So the powerful top PSUs, large cap PSUs, they continue to have a good run. We had Sun Pharma's numbers come out just a while back. That is a stock about 1% higher. And then Reliance to the rescue, keeping the Nifty just around the flat line, at least for now. Nigel.
Well, that's right. Let's get straight then to how do you trade the final hour of trade. Keep in mind, we have the Nifty weekly expiry as well that plays out. Yesterday had the Nifty Bank monthly expiry that played out. So Mitesh Thakkar is back with us to help us out with the trade out there. Mitesh, what do you read of today's action? We started about the 25,000 mark, but we couldn't hold on there. Also fill us in with your trading picks.
Imagine two things. One, we made a fresh high, and two, I think the indicators have failed to make a fresh high till now. So one, in case you break 24,800, then I think we might go into a corrective mode. Otherwise, we need to get past the today's high to make some momentum and see that the indicators carry through the momentum. So it is not a market, which is very comfortable in the sense that we try to get past an important level, but we fail to do that. And again, the culprit is Bank Nifty, which is already in the negative. And, Bank Nifty is clearly still showing signs of underperformance. Wait it out. I think, for the timing, I am not wanting to buy anything because I would want to buy it closer to 24,800 or on a breakout about 25,050. That's the way we'll approach it. And then, we'll take it forward from there. This is not a market which is giving clear signals because we've been continuously trying to make new highs, but at every high, the Bank Nifty has been not, able to get past the previous high or even start making lower highs. So a market which is clearly showing divergence. On the stock side, I have a sell on Glenmark with a stop at about 14.55. Look for targets of around 13.95, 13.90 on the downside, maybe more. And Tata Power is conditional buy. I think it's just on the verge of getting a breakout into fresh highs. So buy it above 465, keep a stop at 455 and look for targets of 485.
All right, got that. Thanks very much, Mitesh. We'll come back to you in a bit and get some more trades in, but lots of earnings to analyze. Let's start with Sun Pharma, the Nifty heavyweight, which released numbers just a while back. Let's go across to Ekta. Ekta, how do the numbers look?
Well, largely an inline set of numbers, you'd have to say, for Sun Pharma this quarter. So, for example, the revenue is up around 6% on a year-on-year basis. The street was estimating around an 8% growth. The EBITDA has come in at around 3,600 odd crores, which is better than estimates. So, it was an operational beat which came in. It margins at around 28.5% with versus estimates of around 26% versus 27% that they did same time last year, around 28 odd percent. Profit also better than estimates, came in at around 2,800 odd crores. Q1Q as well, there was a margin improvement of almost 300 basis points. So that seems to have stood out in terms of the performance this time. We'll wait by for more details such as the specialty business, etc. But if you look at the US formulation sales, they came in at around $466 million, which was down around 1% on a year-on-year basis. Street was anticipating more than $500 million, but one will need to see the details and the fine print of that. Generally, whether or not the specialty business sales are included in that or not. Otherwise, it seems as though the focus was on the operational viability of the company or the margin improvement, and that has come through this time.
Okay, all right, got that. Ekta, thanks very much. Well, let's welcome Deven Choksi into the conversation. Deven, good to have you on. Lots of earnings to discuss. Let's start with Sun Pharma. What did you make of the numbers, and what's your stance on the stock?
Good afternoon, Survi. Well, on the face of it, the numbers looks, I think, impressive. I think for sure. Maybe I think better than the expectation that we carried from the company. In general, I think most of the pharma companies possibly are showing the higher amount of growth in the numbers in this particular quarter. Maybe due to one of the reason that I think the products in specialty generics particularly are fetching them better realization and at better prices, I think, in most of the categories in which I think they've been launched. Not in specific along with the Sun Pharma, but I think rest of the companies as well. So that's what our gathering is. Maybe I think once we study the result in detail, I think we'll get more confirmation of this particular thesis. But overall, I think the number looks, I think, pretty steady. maybe I think the impact of better realization is expected to be seen across, I think, in different product categories or therapeutic categories that we are expecting.
Okay, all right. Hi, Devin. I wanted your view on Ambuja Cements, but let's run through our viewers first. What brokerages have to say? There are a slew of downgrades that have come in on Ambuja Cements. Starting off with DAM Capital, they have gone ahead. They've downgraded the stock to neutral. Target price around 700 rupees. They say yes, the company is on a solid footing. The problem is most of the positives are priced in. They've gone ahead and they've trimmed their EBITDA estimates by 3 to around 4% because they're factoring in lower probability. Why lower profitability? Because the weak pricing scenario that's existing, because of the aggravation of aggression from various larger players. And the second factor is, the closing out of the South-based Penna acquisition. That's what's going to weigh on profitability. They also highlight that valuations have turned unfavorable because they're rather expensive and they're rich. The stock is trading at around 17 times EV per EBITDA, even after factoring in volume growth of close to around 16.5%, even if after factoring in a CAGR on EBITDA per ton improvement of around 9%. So from a longer term perspective, they say the queues are in place. The problem is the stock has run up a little too steeply, and also that's why they're trimming their rating on the stock. Moving to Jefferies, they have trimmed Ambuja Cements consolidated estimates by around 10% for the coming year and by 2% for the next 2 years. What they go on to say is that the key reason is the pricing pressure of the industry. They've also highlighted the cash position has come down. From close to around 24,000 crores, it's come down to around 18,000 crores because of the capex spend as well as working capital cycle has got stretched a little bit. They maintain their positive stance though on both the stocks, that's Ambuja as well as on ACC. Moving to Nuvama then, they have downgraded the stock from buy to hold. They revised the target price of around 722 from around 767. Weak pricing environment, uptick in the stock price, that means that in the near term, well, things could be a little bit subdued for the company. So all these three, DAM, Nuvama, as well as Jefferies, they've gone ahead and they've trimmed estimates, or in fact, they've downgraded the stock, and that one's down close to around 3%. Devin, what's your view on Ambuja Cements?
Yeah, Nigel, I guess I think in the commodity segment, probably I think in a given situation, you may find that the stock is expensive. But I think most importantly, both ACC and Ambuja in the Adani portfolio, they are actually, I think, driving on few counts. On one, I think they want to expand the capacity, combined capacity, about 200 million metric tons in the near future. Important point. Second most important point, I think they have got significantly large amount of limestone reserves. So given the kind of capacity expansion that they want to carry out, I think this result should come handy to them. Important another point would be the logistic arrangement, including the transportation between East Coast to West Coast of cement transportation because of the inland water transportation port facilities available with the group. And last but not the least, I think the energy cost reduction, I think, which is expected to come up. So in all put together, I think it's a pure play on the volume. It's a pure play on, I think, how you bring down the cost. And that's where I probably do not like to look at the company on a quarter-to-quarter basis. I think this particular business should be seen on a relatively longer period of time because they are bringing up the larger capacity and it's going to be a volume play going forward along with the valuations.
Okay, so you'll maintain your positive stance then on them?
That's right.
Okay, all right. So longer term, Ambuja Cement still looks up. Devin, I wanted a view on Tata Steel, but let's run our viewers first. Why the stock opened up in the green and then it did come under pressure. First up, the numbers looked good. Absolute EBITDA number was better. Margins as well on absolute basis was better. India EBITDA per ton was in line, while in Europe, well, we had the loss that was lower than expected. So that's a positive as well. The net debt number, though, that moved up on a sequential basis from around 77,000 crores to around 82,000 crores. What's the problem then? The debt is moving up. They have a big capex underway. So the street is a little bit cautious on that front. There's also an event risk because the Supreme Court's final judgment, that's going to be a bit of an overhang. What's that? Last week itself, the Supreme Court said that the states can go ahead and they can levy higher taxes on these mining companies. So for the time being, Tata Steel, they have been marking this out. They continue to mark this out. They have now marked close to 17,000 crores as a contingent liability if this higher taxes by state governments is levied on a retrospective basis. In terms of the commentary that they gave us, they made this point that Chinese prices, yes, they're under pressure, but they're likely to have bottomed out. They're guiding for around 1.4 million tons of additional volumes in the coming year in comparison to last year from India because Kalinganagar comes on stream. They're saying India as well as Europe in the near term. That's for Q2. Profitability will be under pressure, but for the second half of the year, they're expecting some kind of a revival. And net debt to EBITDA for the year will be more or less flattish. They go on to say with regard to the contingent liability on a retrospective basis, it will be 17,000 crores. But if from here on a prospective basis, if those higher state taxes need to come into play, then they'll be hit by close to around 1,500 crores on a per annum basis. So put all this together, the numbers look good. The problem is on this contingent liability as well as the rising debt. Dev, in your view?
Yeah, Nigel, I think you summarized it all. I guess I think the challenge is that if the Supreme Court ruling favors the state to levy the taxes on the mining in Orissa, with a retrospective effect, this could be, I think, a very dampening kind of a situation because I think that would probably give freedom to one and any other state, I think, to start bringing this entire tax management under the retrospective basis. Hope, I think, that doesn't work that way. But I think if it is not retrospective and if it is, I think, on a prospective basis, then probably I think they have at least the ability to pass over the cost on this particular tax that I think the states are talking about. So to a greater extent, I think a lot would depend on this particular overhang of the Supreme Court judgment. I think one will have to wait and see. Till that point of time, I believe that the stock possibly, even though the fundamentals are in place, profits are, I think, absolutely in place, demand scenario remains buoyant. All in all put together, I think the minus this particular factor, the company should otherwise do well in coming period. But we'll have to wait and see on this particular judgment which comes out in due course of time.
Okay. Afternoon, Deven. What about the auto sales? So M&M is seeing a sharp fall of about 2.7%. In the month gone by, the automotive sales were a bit disappointing. We had a chat with the management also earlier. Where do you stand on Mahindra & Mahindra?
Well, again, I think, Dima, good afternoon. Again, I believe that I think don't look at these companies on a month-to-month or a quarter-to-quarter basis. I think the long-term prospects seems absolutely convincing in most of the auto companies, be it Maruti, be it Tata Motors, be it Mahindra & Mahindra, for that matter. I think on one side, the commercial vehicle segment is showing a distinct signs of growth and I think smart growth with the profits also. On the other side, I think the passenger vehicle, though in 1 or 2 months, I think may remain a little subdued. But I think given the kind of demand scenario which is emerging in the country, I would remain bullish. So maybe corrections in the price, stock price, I think is a welcome opportunity. In fact, I think in most of the companies' case, I think the price have actually, I think, reached to the premium level. In this kind of a scenario, when the premium level price gets corrected, it becomes a buy opportunity. So as a long-term direction, I think we remain fully convinced about the auto and auto play. Maybe corrections would mean a meaningful entry back into these counters.
Right, Devin, we'll leave it on that note for today. Thank you very much for joining in. Got lots of earnings to go over, and Dabur's come out with numbers just a while back. In fact, the numbers came out, I think, just less than half an hour ago, and they look pretty good. The volume growth is about 5.2%. The poll was expecting, growth of around 5 to 6%, and we're looking at the EBITDA rising by about 8.3% year on year. That's come through. To talk about this, we have with us Mr. Mohit Malhotra, the CEO of Dabur India. Mr. Malhotra, great to have you on. Thanks for joining in. And I'm going to take off from, where we left last quarter, where you were telling us that the rural recovery is really looking strong. So tell us more. How has rural performed, and what's the difference between urban and rural growth for you right now? This 5% volume, how much of it is rural India? How much is urban?
Right. Thank you for having me. So rural definitely for past 3 quarters is inching ahead of urban. For it's around 350 basis points ahead. Rural is ahead of urban. My rural growth was 9% and urban growth was in the range of around 5%. So therefore overall around 7%. And we are very positive about rural, and that's how the growth has been coming. So we've been putting ahead of the curve, a lot of distribution initiatives in rural, a lot of activations have happened in the rural. And third vector has been, a lot of media has been increased in FTA channels. There's a 50% increase in the media for mobilizing demand in the rural. So all this has paid off, and 9% rural growth is, we are very happy with it, yeah.
That's absolutely fantastic. I think last quarter you were 8% rural growth. Now that's moving up to 9%. Given the strength of the rural recovery and what you're seeing, would you want to increase your overall guidance? I think you were at about 8 to 9% growth for the full year. But now with rural doing so well, would you look at double-digit growth?
I think we really don't know how it, waves up. So while the monsoon has been great and the government outlay also has been increased for rural, for both agriculture and also the rural sector. So I think sequentially there should be improvement. And 4, 5, 6% has been sequential in past 3 quarters. We expect improvement to happen. To give an exact guidance, it will be very difficult for me to give, but we stick to our guidance for the full year, which is high single-digit kind of a volume growth, and majority of the growth will only come from volume because there's not much of a price increase there, maybe a 2% on price increase, and the rest will all come from volume growth driven by rural recovery.
Okay, so high single-digit kind of volume growth, and you expect the sequential recovery in volumes to continue. So rural, at least comfortably, we can say should be in double digits, right?
We think so, yeah.
Yeah. Okay. What about the international business? What's the sustainable revenue growth for the next 3 quarters?
The international business has grown by around 18.4%, and international business across markets has been growing at double digits for us. MENA, which is a very big percentage of our business, has grown by around 12.5%. Turkey business around 18%. Egypt has been growing at around 64%, etc. So overall 18%. So we expect a double-digit growth trajectory to continue for the full year in constant currency in international business. For us, there has been currency depreciation. That's why the translated growth in India has been low. But double-digit constant currency growth on back of market share increases in consolidating our business in all our international markets will continue going forward.
Right. Mohit, hi. So just 2 points. One, have you taken price? You indicated last time some 2-3% price increases. Have increases come through in the quarter?
See, we've taken around 2% price increases in the quarter. Major price increases are flow through from our previous quarters to this quarter. If you look at the overall price increases are to the tune of around 5 to 6% in our healthcare, around 1% in our home and personal care, and no price increases in our beverage portfolio. So that's the way the price increases have been. Inflation is coming down. Overall, we've seen deflation in the quarter of around 2% or deflation. But as the food prices backed by fruits, vegetables, cereals is inching up, the food inflation is high in the country. So we might take some price increases in our foods portfolio going forward here.
Mr. Malhotra, since you mentioned beverages, I have to ask you this, right? Because the quarter also saw lots of noise around what can be called 100% real juice and what can't be, the FSSAI ruling. What has been Dabur's approach? Did you undertake any new branding or rebranding exercise? And did that have any impact on demand, on the sales?
Not at all. I think as of now, there's nothing. And whatever happens will be happening for the entire industry. So I think Dabur will not be an exception to whatever is happening in the industry. But we have made representations to FSSAI, and scientific board of FSSAI is actually evaluating on what the industry has to say. So CII, FICCI, and we are a part of it, and we've represented to them. And they shall come back to us on the labeling requirements for the juices, yes. But we are 100% juice, so therefore representations have actually gone to them.
Last quarter, you had gained about a 20 basis points market share in oral care. What's the market share in the current quarter? Because one of your peers, Colgate, reported some very strong numbers.
Yeah. So I think our numbers in the oral care category, we've gained around 15 basis point market share in oral care. The herbal category continues to grow ahead of the non-herbal category, and herbal category is now around 31% of the overall market, and we are market leaders in the herbal category. We're growing the category as leaders ourselves, and the Red Toothpaste, which is our flagship brand, continues to do very well and gain market shares. Our growth in oral care has been to the tune of around 12.2%. in secondary terms and 11% in primary terms, mainly driven by, again, volume surges of around 8% there. Yeah.
Okay, and final question on margins, Mr. Malhotra, you're very close to 20% and you're saying that raw material inflation has actually come off. You're looking at some more select price hikes as well. So is 20% plus, is that a territory that you think you will be in for the rest of the year?
Again, guidance is difficult for us to give. We've increased our gross margin on back of inflation and some price increases that we've taken. Apart from the gross margin increase, we've invested in media. Our media has grown by around 15%, which is double of our top line growth of 7%. So we'll continue to invest behind media. And whatever balance, Samriddhi benefit and cost optimization that we do during the course of the year will flow into our operating margin. So it will definitely be better than last year, but I can't really tell you how much to what level it is. 19.6 is what we registered. So I don't know to what extent it will be great. Giving you guidance is actually difficult at this stage. But
Mohit, thank you.
Definitely maintain or be better in margins, yes.
Okay, so double-digit volume growth, high single-digit volume growth, and will maintain or do better on the margin front. Thank you very much, Mohit, for joining in. We'll get into a break. On the other side, we'll invite Karthik Kumar from Axis Mutual Fund. Stay tuned.
Okay, welcome back. You got the market, which is, I don't want to say momentum flagging, but it's not building on after taking out the 25,000 mark. So just under it, 24,982. Broader market's much weaker. as has been the case. Mid-cap and small-cap indices are both down 1% each. Karthik Kumar is fund manager at Axis Mutual Fund. Karthik, good to have you with us here on the program as always. Since you run a quant fund, could you give us a sense of how you are looking at the market structure, underlying momentum, relative strength, etc.? Is it in the near term? Is it looking as strong? Momentum elsewhere around the world has been intermittently flagging, except here.
Firstly, thanks for having me. In terms of the market itself, while the risk appetite has been pretty good, as is evident from the fact that markets been able to digest a bit of negative information over the last couple of months, be it from politics to change in LTCG and SCG and so on and so forth. But what you see is the risk appetite is still there. One is you can see it from the flows, strength of the flows. The other is if you look at the performance of the bucket of most volatile stocks, that bucket of volatile stocks still continue to do well. So clearly we are not in a risk of mode by any means. But what we are seeing is there is a change in the underlying structure if you scratch the surface. Earlier, if you go back 3 to 4 months back, from a style perspective, the markets were driven by valuations followed by growth and momentum very closely. But now over the last 2-3 months, what you're seeing is quality has taken the lead. It has come back after some time in wilderness, and quality and valuations together are doing well. That is also evident from the fact that some sectors, the sectors that have done well over the last couple of months, be it staples, healthcare, IT, pharma, all of them more representative of like the quality basket. That's one way of looking at it. The other way of looking at it is markets looking at laggards now. Participants are looking at laggards now. Whether you define laggards in one of the two ways, one is that it's lagged from a price return standpoint over, let's say, 1 to 2 year horizon, or you look at it as a laggard / valuation reversion theme where some of the sectors that have lagged are at a valuation discount to the markets are also kind of catching up there. So that's what I see from a trend perspective, from an underlying style perspective, and that presents fair bit of opportunities from a positioning standpoint.
But, IT, pharma, staples, you'd rather describe them as defensive or quality? Because when you assign them the quality label, it automatically means the other stuff is not high quality. And also, secondly, Karthik, that was just in jest, but actually, you may want to answer it if you want to. Second is, as you go higher, as you keep going higher, in every market it happens, right? The quality of new ideas keeps coming down because at the end of the day, there's only so many high quality ideas that one can come up with. But if money is coming in and you've got to put in money, you are hard pressed for ideas. So you start to look at things which you normally would not do. So does that kind of make sense to the last point that you made, which is laggards, which are starting to pick up? Go on.
Firstly, you're absolutely spot on in the sense that with quality, even the basket of quality, the nature of the quality basket has changed over the last 4-5 years. Previously, they would be dominated by these sectors for a lot of fundamental reasons that we could have gone in detail had we had the luxury of time. But over the last 4-5 years, what we've seen is the quality basket itself has diversified to include a lot of these cyclical sectors as well. I also refer to some of these sectors more from a popular view standpoint, where these sectors are normally associated with quality. With regards to your point on the fact that as markets start rallying, as markets start going up, finding quality ideas become difficult. While that is true, what we've seen in our markets is that the market was broad-based even from the start. So it was never concentrated in the top 10 or the top 15 stocks, whereas which was very unlike the West, and it was quite broad-based. So the breadth of the market has been working for quite some time. So I look at laggards more from a valuation reversion standpoint is how I look at it.
Getting specifics, getting to a bit specific, what about technology? You were, I think, earlier underweight on technology, but now some of the large cap IT companies have reported green shoots in their growth metrics. Would you be looking to change your assessment on tech?
I still continue to remain underweight tech. While the numbers that companies have reported are pretty much in line and they've reiterated their forecast, and that has resulted in the earnings environment for the IT companies in general, earlier the earnings revisions were quite negative, and that pace of revisions has come off materially. So that space has improved, but still the earnings environment over the next 2 years hasn't flipped to positive. So I still continue to remain quite selective within IT, and I continue to remain underweight this space as a whole.
Okay, so underweight IT. What about some of the other sectors? Let's look at auto, for instance, or anything else through which you would play manufacturing. What would the picks be?
I've been overweight autos, auto ancillaries. I've been overweight the entire power theme through different sectors. Obviously, the power theme can be played across sectors, and so I've had exposure to power theme through different sectors and subsectors. So those are the two ways we are playing manufacturing. But apart from that, I'm also overweight pharma, and I'm overweight staples as well. Selectively within staples, but staples is more a function of stock selection rather than sector allocation call.
What about QSRs? They've been laggards. Are you expecting any sort of a mean reversion here?
QSR, I still don't see it as a mean reversion candidate because the earnings environment still continues to remain tough. The results that have come in so far have also been lukewarm as well. So I think with QSR, we continue to remain bearish on that space.
Specialty chemicals?
Specialty chemicals, I've had increase in that I've increased allocation to that sector, through stock specific bets there. Less of a sector bet, that and staples are less of a sector bet, but more of a stock specific allocation.
By the way, I just want to sort of just to pull back, Karthik, to go back to that laggard point. Is this? Do you find more and more looking at opportunities where it's all relative? I mean, you're not looking at absolute ideas, but you're basically, as you yourself said, right? You're looking at some of these mean reversion ideas. If something is trading at this, why shouldn't this trade higher? I don't know how. Is that it works absolutely, but. What would you make of it? And do you find yourself doing that? I mean, all of us do, I guess.
See, all of us do, because at the end of the day, for us, the market is the opportunity cost, and when our options are limited to what we see within the market. So if we do see sizable differences in valuation spectrum, then we all are bound to take advantage of it. But that on its own will not work. Just because a stock or a sector trades at a valuation discount to its historical valuations, or for that matter, its peer valuations or other sector valuations, that alone is not the reason for it to work. You need to have other drivers. It could be through better cash flows, or it could be through better earnings expectations, or there could be other near-term kickers in there that will cause that reversion play to kind of kick on. But that on its own is not the only condition you would look at.
Well, we'll leave it there, Karthik, for today. Thank you very much for your time. Appreciate it very much here on CNBC-TV18. Well, that's a quick conversation with Karthik of Kotak Mutual Fund with perspectives. Sudarshan is here, our colleague, with what the July sales overall is looking like. What's the takeaway? Sudarshan, take it away.
So it was largely a muted month for the auto companies, with majority of the companies reporting sales below estimates or were largely in line. So we'll start with Bajaj Auto. Amongst all the companies, it's the one company which has reported numbers that were largely in line. So total sales were at 3.54 lakh units versus Nomura's estimate of 3.50 lakh units, and the sales were up 11%, and two-wheeler sales were up 11% as well. Exports have seen a minor growth of 2%. Speaking to CNBC-TV18, company says it expects sales momentum to continue going forward, and overall growth in exports is going to be steady but in small steps. Next is M&M. Again, here also it was a mixed set of numbers. Auto segment has missed estimates, while tractor segment has reported numbers that were higher. Total auto sales were up 0.5%, while tractor segment sales were up 8% year-on-year. Company says upcoming festive season is looking very promising for the tractor industry. Next is Escorts Kubota. Total sales have seen a minor growth of 3.6%, and like M&M, it also expects rural demand to improve during the festive season. Next is Tata Motors. Overall sales were below estimates, dragged by CV segment. CV segment has seen a fall of 18% year-on-year, and total sales were down 11%, and EV sales also have seen a fall this time, and it has fallen 21% year-on-year. Last is Ashok Leyland. Again, it has missed estimates as M&CV sales have seen a drop. Total sales were at 13,928 units versus nominal estimate of 15,000 units, and it was down 8%, and M&HCV sales were down 12%, 8,440 units. So overall sales for the month of July were largely muted for the majority of the auto companies.
Thank you very much for that. We will slip into a very short break. On the other side, we'll get a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls from our technical experts.
Welcome back. Well, keep an eye out on Zomato. Those numbers are just hitting the exchanges and they look quite good actually. Explains why the stock has moved to the high point of the day. The EBITDA number for the quarter has come in at around 177 crores. That compares with an EBITDA loss. Even on the revenue front, that's seen a massive growth of more than 70%, coming at around 4,200 crores. Or I think most on the street were anticipating a number south of 4,000 crores. So that in itself is a beat. And that explains why the stock has moved up. Keep in mind, it's already rallied considerably. But for the time being, prima facie, the numbers that we have, well, they look good. And that's why we're seeing a bit of an uptake. But to get further analysis, Mangalam will be joining in just a bit to give us the fine print. But for starters, these numbers look good. Well, good time then to find out what's going on in dealing room. By the time Mangalam, fixes those numbers, Nimesh joins us to tell us about today's session. Well, Nimesh, finally 25,000 came.
Finally 25 came,
but
yes.
we couldn't hold about those levels.
And that's going to be some technical reasons as well. So nothing, much to read into it. So, honestly, a bit of profit booking is par for the course. But again, the bigger thing is that there is buying interest. And this rally is led by institutional buying, especially the DI buying. So that seems to be the trend today as well. In fact, today the ratio seems to be quite, in the favor of the buy side. So the ratio is almost 4:1. So there are 4 buys and 1 sell. That's the kind of ratio which has been shared to me in the morning. In fact, there is a small MOC buy as well at a leading FI desk. So looks like some bit of buying will come in the last 30 minutes of trade. The only explanation that I got for a bit of underperformance in the broader market today seems to be largely technical in nature. We all know that the circular had come, right? The 1,000 stocks will be out of the funding list in a phased manner. Yeah. Today is the first phase where the 30% haircut will be removed, right? So that explains that there is a bit of pressure in the broader market stocks, purely technical in nature, and that's the reason why that index is also down nearly 1%, and also that explains a bit of underperformance in the broader market. Selectively, there is a bit of buying back in the PSU names. Again, a bit of interest from the domestic mutual funds. So broadly, it looks like there is enough cushion from the domestic mutual funds who are absorbing the FISL flows. And again, as I said, the mid-cap underperformance seems to be purely technical in nature.
To sum up whatever you said, Nimesh, it looks like it's more positive than negative. So that's good news. But you're talking about some PSUs. I think one of them wants to raise some money as well. Tell us the stocks you're tracking.
Right. So in terms of individual names, the first stock on my list is Entro Healthcare, a recent listing. That stock is buzzing in trade, good volumes as well, up 5% last I checked. The street is anticipating now a large acquisition from the company very soon. That's the corporate development on which potentially the stock has been buzzing in trade today. So that's the first name. The second stock is PNB. Within the bank, PSU banks, this is one stock. Post earnings have done well, been reacting to positive numbers as well. Now the buzz is that maybe the bank is very close to raising money via QIP very soon. So that's the second name. The third stock is NBCC. Again, been a big mover of late. But again, there is a lot of traction from larger HNIs, seems to be quite active as well. And again, from a flow perspective, I understand some domestic mutual funds are quite active buyers in NBCC of late. And the last couple of stocks, cash stocks, where there is a selling pressure, which is CDSL and PB Fintech. Both are under pressure today, largely on back of sell-flows at FID. So expect high delivery volumes. And there is delivery selling in both these names today.
Okay, thank you very much for that. But the stock of the moment right now is Zomato on the back of the Q1 numbers. There's a big profit of about 250 crore and a sharp jump in the company's revenues to 74% increase. Mangalam joins in with the highlights. Mangalam.
Well, that's the beauty of operating leverage, right? When the company turned profitable for the first time, same time last quarter, they turned in a profit of 2 crore rupees. And in 4 quarters, the numbers actually swelled all the way up to 254 crore rupees. What is this led by? This is led by improved operational performance in their food business, reduction of losses in the quick commerce business with massive growth coming out there as well. So if you just look at all the numbers that are reported, 74% growth in their overall revenue, close to 4,200 crores. The EBITDA from a loss of 48 crores has turned into 177 crores in terms of EBITDA. Margins at close to 4.2%. Net profit at 253 crores versus 2 crores. Remember, Zomato, by virtue of the near 12,000 crore cash that it has on its books, also generates a fair amount of other income. And this time around, the other income has come at around 236 crores versus 181 crores. Now, onto the segments. Food delivery has continued to grow 41%. We were awaiting about 20% GOV growth, but the net revenue of the food business has grown 41% and the EBIT has grown 73%. Margins in the food business improved from 13.5% all the way up to 16.5%. Quick commerce, that has actually, excited the street the most out there. Revenue growth has been 150%. The street was hoping for more than 100% GOV growth out there. So net revenue growth of 145%, the street really likes. And look at the operational improvement out there. Same time last quarter, they had an EBIT loss of 105 crores. Now that's turned EBIT positive to the tune of 43 crores. In the previous quarter, that's Q4, they made an EBIT positive growth of close to around 2 odd crores. That itself has surged all the way up to 43 crores, and that's something that the street likes. Hyperpure as well, while it still continues to be loss-making, the revenue growth is something that is exciting. A 96% jump out there from 617 crores to 1212 crores. Net-net, all levers for Zomato firing. Good growth in their food delivery business with operational performance improvement. Massive growth in quick commerce with reduction of losses and possible EBITDA positivity as well. And good growth continues for Hyperpure. All in all, 2 thumbs up for Zomato's numbers.
Okay, can't fault these numbers for anything, can we?
This calls for a delivery.
Actually, Swiggy in my lunch, but never mind. That's a really great number from Zomato. Mangalam, thank you very much for that. TVS Motors, the monthly sales numbers are coming through. 3.5 is what they have done. 9% higher. Seems to be slightly higher than some of the estimates that we had on the street. That's Zomato. Let's get TVS Motors, the other stock up, which is also reacting quite well to those monthly sales numbers. So some good news coming in on a couple of these stocks. Mitesh is joining in. Mitesh, while we talk, the final calls, just throw in a word on Zomato as well, because fundamentally the news has just gotten consistently better. The stock has also had a great run. What's the view now?
Yeah. See, Zomato, I think, continues to make new highs, and that is a very positive chart setup. Now the previous high was around 229, and today is trading above that. I think this can be trading by with a stop at 226, and 250 should be the next target area over here. And on my stock side, Tata Cement, I think that's a BTST. Tata Cement is closing at the day's high. So buy here with a stop at 11,900 for targets of 12,200 plus. And Shriram Finance is a BTST with a stop at 2970 for targets of 3040.
Okay, thank you very much for that. Ambrish Baliga is now joining us on the show for the last 12-13 minutes of trade. Ambrish, first, Zomato, would you recommend a buy at these levels?
Yeah, I mean, especially after the sort of numbers which have come, I think one can still look at buying, although the stock has moved up quite sharply. Clearly that platform fee also which they had introduced, they've increased that now to 6. I think that has also contributed to a certain extent in these earnings. And clearly, the sort of EBITDA roadmap which they had set out to achieve, I think that's clearly being achieved. So I think we should see levels of about 270, 280 possibly in the next 4 to 6 months.
Okay, all right. Got that, Ambrish. Just want to focus on a couple of mid-cap IT earnings that came in. We didn't speak about them. So many of earnings have come. But today's real disaster has been Sonata. Sonata is nursing losses to the tune of almost 9 to 10%. Margins, compressed very sharply. I think about a 300 basis points margin compression is what the company reported. Though there was top-line growth and the stock is really on a roller coaster. Some of the other numbers as well. Sasken was a little flat. OnMobile Global had a tough quarter. I think there was a loss over there. So some of these tech companies, tier 2, tier 3 tech companies, not had a great reporting over the last 24 hours. Amrish, any thoughts? I don't know if you look at them. Sonata, if you do, big disappointment over there.
Right. That's true. I think it's a big disappointment. And I suppose across some of the mid-cap IT names, I think we will see that amount of disappointment even going ahead with the numbers which are remaining. I think it's still time to, pick up the large cap IT stocks. Even a stock like Infosys, although there was this adverse news, I think that's an option to buy these at slightly lower levels. Because clearly in IT, overall, we are seeing some green shoots. And I think the large caps will be the first ones to benefit out of that. So still on my buy list is Infosys, TCS, as well as Wipro, where we had seen some disappointment, but I think even Wipro at these levels can be bought.
Okay. By the way, the Nifty is also moved up, not to the high point, because the high on today is 25,078. So one is still about 60 points away, 55 points away from the high, which was right, of course, at the word go this morning. But definitely a big improvement over the absolutely lackluster kind of session we were having when we started. When we started, it was absolutely flat on the Nifty. Look at the Bank Nifty as well, if we can, before we go into a break. The banks have nothing, no help from Nifty Bank, absolutely flat. And mid caps and small caps are the other places. There is a small recovery, 20 basis point recovery on the mid cap index, and something similar for the small cap index as well in the last 10 minutes, 20 minutes or so of trade. Take a break. We'll come back. Ambrish, of course, is still with us. We'll ask him for his pick and some more stock ideas. Stay tuned.
Welcome back. Markets are moving back towards the high point of the day. HDFC Bank, that one's come in for a big spike as we speak, and that's the big boy that's taking the markets higher. But in fact, the other big boy, ITC, will be reporting its numbers post-market hours. Mangalam joins us to help us out with the key expectations. Mangalam?
Well, in the month of July, ITC had a good run, up almost 16% because there was no tax hike in the budget coming in, improvement in rural outlook and valuation support. All of that took the stock higher. So now what is it that the street is expecting this time around? Let's put it down to numbers. 2 to 3% volume growth in the cigarette business, 7 to 8% in FMCG revenue, 8 to 9% increase in hotel business, which would be a bit of a slowdown given the weakness in seasonality in the sector. Agri revenues 0 to 2% flattish out there, whereas the paper business would be negative in terms of a top line performance, largely because of sectoral weakness itself. So club all of that together, on an overall basis, you expect around 5.5% growth in the standalone revenue of ITC, 16,700 crore on the top line. EBITDA grows about 2.5%. You're looking at margins around 38.5% odd, and that would result into a net profit growth of about 4%. The number you're looking at, 5,100 crores. The company obviously does not give any cigarette volume growth guidance, but any uptick out there is something that the street would like. And apart from that, the improvement in FMCG margins is something that we'll keep an eye out on in particular.
Okay, all right. Thanks a lot for that, Manglam. We'll keep an eye out on ITC. Big recovery in the last 45 days or so, from 420 to around 490 rupees. But let's go back to Amrish. Amrish, let's keep ITC aside. You normally give us one pick that you're looking at. Which one is it this time around?
Nigel, my pick is APL Apollo, which is the largest structural tube manufacturer in India with a market share of about 50%. Globally, in fact, they have the widest range. And the company has consistently expanded its capacity. I mean, if you go back to 2006, it was 53,000 tons per annum, and now it's about 4 million tons. I mean, they've grown through organic and inorganic route. And currently, again, they're expanding this capacity to about 5 million tons by end of FY25. I think it's an attractive bet as structural steel tube consumption has been increasing because of its use in residential and commercial buildings, hospitals, educational complexes, warehouses. And as far as airport construction is concerned, they have a 70% market share. And now I think railway station redevelopment, I think that's a huge opportunity going ahead. If you look at the Q4 numbers, they were a bit disappointing, but with the expected capacity like ramp up in the Raipur and the Dubai facilities, I think the Q1 margins should see a decent uptick and could actually surprise the street. So looking at FY26 EPS of about 50, my target is about 2,000.
Okay. All right. So that's APL Apollo. By the way, some of the PSUs are closing with a flourish today. Power Grid, Coal India, ONGC, a lot of these stocks on the upside. I know, Amrish, you've been, cautioning on PSUs given the huge rally. But is there anything you like, maybe the larger names, anything that you would still buy?
I would surely buy into the power stocks like NTPC. That's still on my buy list. Although we have seen a decent move, but still from here, I see a level of about 480 to 490, possibly over the next 6 to 8 months.
Okay, got that. By the way, out of the results which are coming through, Amrish, anything caught your eye today, yesterday? Flurry of earnings, and many times, especially the smaller ones, you get a reaction a day or two later. Take Zaggle as an example. Big move today. Earnings came a couple of days back. We had the management a couple of days back with us, but 8% higher today.
I don't track that stock very closely, but the stocks which we just discussed, the IT mid-cap, I think that's where possibly we could see even further disappointments. The one which came today, Sonata, I think that was a disappointment to a large extent. So mid-cap IT, I would be going a bit slow. Like I said, I would prefer to possibly concentrate on the large cap ones.
We had Mr. Sanjeev Goenka with us, and his group companies are all buzzing once again. Big numbers, though, and why not, right? It's not a broker which is putting out estimates. This is the promoter of the company. Philips Carbon Black, CESC. You like anything in that space? I'm not asking about the IT company because you already said disappointments there. The other two.
Among those two, I would surely prefer CESC, which again I've been recommending all through. Right from the 90 levels, I've been recommending CESC, and every time I've increased the target. And even now, I would say, a stock like this can easily see levels of about 200, 210.
Adani Energy is a big one today. Big mover, 11% gain on pretty large volumes. Amrish, anything here? They came out with the numbers. There is that QIP fundraise too.
You're talking about Adani?
Adani Energy, yes.
Yeah. Because of fundraise they've done, and I think they've done at extremely decent levels despite the discount. Looking at that fundraise and the performance, I think we should see better levels from here. I'll not be surprised if we see levels closer to about 1450, 1475.
Okay, all right, Amrish, we'll leave it on that note. Getting down to the close now, and let's see if the adjusted close can indeed be above 25,000. That's where there was a bit of a fight, but for what it's worth, the milestone was crossed today. A lot of PSU stocks leading from the front: Power Grid, Coal India, ONGC, NTPC, HDFC Bank out with a charge, really outperforming the rest of the bank nifty because it was just HDFC, a lone ranger. A lot of other banking names like Kotak Mahindra Bank, SBI, etc., they've all had a negative session, but HDFC really was standing tall. It had company in the form of Reliance, the other one that managed to pull its weight to keep the Nifty above 25,000. Other gainers of the day included the likes of Adani Enterprises, Tata Consumer, Shriram Finance and Maruti Suzuki. Speaking of Maruti Suzuki, some of the other auto stocks have had a lot of profit taking today. M&M, Hero, Moto, as well as Tata Motors, all these stocks down between 1 and 3%.
Well, the mid-cap index ends with a cut of about 500 points, with 0.8% lower at the index level. On the way up, Zomato deserves mention, came out with numbers, a big profit number of 250 crore. The stock spikes up 3.7%. Other notable gainers include CESC, even Firstsource. So the entire RP Sanjeev Goenka group was higher. Firstsource ending with a gain of about 10%. Philips Carbon Black or PCBL also up nearly 7%. And this month itself, PCBL is up nearly 37%. Oil India, Adani Energy are some more which catch your attention.
Absolutely. A lot of action, but more down than up in the broader markets, as you said. It's a wrap on this edition of Closing Bell from all of us here. Goodbye. Thank you for staying with us. Markets Forward picks up on all the action in just a bit. Stay with us.